Hello, welcome to Liquidity Event Lessons. I'm Ryan Ross. Today on Liquidity Event Lessons, we spoke with AJ Campo, who is a CPA from what I think is one of the best states in the union, New Jersey. That's right. AJ, who is vocal on Twitter, his handle is at AJ the CPA 1226. He helps ultra high net worth individuals with their tax strategies. And we talk about how he started in the industry, and then we discussed why a qualified and licensed tax advisor is crucial for high net worth individuals and closely held businesses. We talk about proactive tax planning and why it's essential for mitigating the tax liability and taking advantage of tax saving opportunities. We talk about moving to different states. Sometimes you sell your business, you want to move to a different state. We talk about that and how to consider something called the AMT. We talk about diversification and using tax mitigation strategies that can help reduce tax burdens for individuals if they have a concentrated stock portfolio. Maybe they work at a company, you work at a Fortune 500, and you got a lot of stock in one company. You want to figure out how you can reduce your tax burden if you want to sell. And then finally, we talk about the step-up basis upon death and how it can provide significant tax benefits even if you've inherited those assets. And when you do inherit those assets, you're going to be liable for a large tax liability if you get inheritance. There's a way to sidestep that. So we talk about all those things. Enjoy this conversation with AJ Campo. All right. AJ Campo, tell us about who you are and what do you do?
So I am the president and owner of Campo Financial Group. I am a CPA based out of New Jersey. We work with high net worth individuals, closely held businesses, working with, owners with succession planning, or if they're trying to sell their business, buy a business, right, due diligence and those things. And then high net worth individuals with tax planning, if they're looking to move, gift and estate, planning as well. It's all crucial at those levels. So that's where it's the pond we like to swim in.
Okay. And have you always been in the tax industry, or have you bounced around at all?
So taxes are my second career. I was in finance for a couple of years. We all remember what happened around 2008. I went back to grad school, got my MBA in accounting, and then I was in finance before, so I just kind of pivoted over to more just accounting focused. So I got my MBA in accounting. Ended up working for Deloitte for a couple of years, was in their audit and tax practice, and then stuck with tax. And here I am.
Got it. We have a variety of questions for you about taxes, of course, and I have a kind of a real-life example of this from the perspective of somebody, a corporate executive. You work with corporate executives, right?
We do.
Perfect. So I just kind of want to we can start talking about this, and that'll probably go on different other tangents. But
Sure.
The real life example of this is, so my wife and I used to be with KPMG. She was assigned by her company. It's a Fortune 100 company, and that lasted about like 3 years, right? And they were kind of our go-to, helping us with our taxes. And then earlier this year, we got a note. I sent them an email. I'm like, "Are you guys? What do I need to do to file my taxes?" And they said, "Oh, we're not doing that this year, but have a great life." And I'm like, "Okay." So,
That's nice.
do you run into situations where for whatever reason, a family is like told like we're not servicing you anymore, or maybe they're not told, they hear from somebody else, they just have to like make moves quickly because it's like approaching the end of the tax season, right? And they're just like, "What do I do?"
Right. Haven't been in that, like I said, that specific scenario, but we do get calls where, again, their advisor has suddenly passed away, right? And that typically happens. Sometimes it can happen, say now. Summertime's a really great time to find a new advisor. It gives us time to really kind of review your prior stuff and really kind of, there's still time to kind of tax plan. So proactive planning, right? Sort of versus the reactive that most people are used to. And then the other pieces are that they were told by their now former advisor, like, we're not doing individual returns anymore. We're not working with individuals. We're just working on businesses. So if they just completely cut off that service line, then yeah, people are kind of left scrambling. Those things typically happen around between now and say the end of the year, so that it's not so much of a scramble type of thing. But the passing away suddenly type of thing, that's where a lot of people are kind of left like, oh no, like, I got to find an accountant, and who do I call? Where do I go? And unfortunately, it's getting tougher to find accountants these days. There is a big supply issue when it comes to qualified accountants. So.
And how do you know that somebody is qualified? It sounds really basic, but like, are there any like certifications that people should be looking for, or how do you know?
I mean, first thing is the IRS has a database where any registered advisor, tax advisor, either they're an enrolled agent, so they have an EA designation, or a CPA. If they have a PTIN and they're registered with the IRS to do taxes, you can search that database. You can also search your state, Department of Commerce. Typically are the ones who issue the licenses, so you can search those. So in New Jersey, for example, you can search my name on the state website. I'm also licensed in New York. You could search that as well. So that's the first thing you should do to make sure you're at least working with a licensed advisor versus someone who just says, yeah, I do taxes, and it's kind of on the side, and it's, they don't sign the return. That's what's referred to as a ghost preparer, right? So it's like you pay someone to do your taxes, and at the bottom it says self-prepared. They didn't sign it. So at the end of the day, if the IRS asks you any questions, you say, hey, I paid someone to do it, that person probably will be gone, gone like the wind, so to speak. So you just want to make sure that, again, someone's licensed. A couple of things that I recommend people ask is how many people are on their staff, how many returns do they do, because that will tell you if you're working with a volume shop versus a small advisory practice. If it's a 4-person office that's doing 3,000 returns, it's a volume shop. All right, you're not really going to get the attention to detail. It's just, hey, give me your stuff. It's out the door because I have to do the next return and the next return and get it out. So really, there's no time to spend and really kind of, hey, I noticed this or I noticed that. It's just next. So the smaller firms are, with less volume are probably going to be a better fit if that's what you're looking for. Otherwise, H&R Block, TurboTax might be a good fit if your needs are very basic and your returns are very simple.
Yeah. Regarding like how you work with different types of clients, right? So you might have business owners and they have specific needs. Maybe you have corporate executives that are W-2 but they might have more complex needs because they do have higher cash coming in. What are the differences between those cases, and how do you guys approach them?
So what we did was we delineated levels of service, right? So we have a basic compliance level, a collaboration level, and a concierge level. So the compliance level is just more your basic return. That's really all you get. There really isn't more advisory or consulting that's associated with that. The collaboration level does provide access to us, for say 1 to 2 meetings a year. If you have some questions throughout the year, you can reach out to us, and then you kind of have access to an advisor sporadically throughout the year. The concierge level is more of the really hands-on, high touch, right? We're meeting quarterly. We're doing quarterly projections for you. That's kind of where the startups, those executives fall into that package, right? Because it's, are you looking to exercise stock? Did you exercise? Do we have to make estimated tax payments? Are you looking to move? There's a multitude of things that you can discuss with these individuals that do require, high touch, more touch points throughout the year, and that's kind of the bucket that they fill in. So we try to do our best to kind of delineate those levels that, someone could be like, all right, well, if I want access to you, then you're in this level, or I just want you to do my return, to make sure it's done right and that's it, and then you're more in the compliance level. So that's kind of our approach with it.
For that concierge, I think you said it was called concierge level. You said that it is you're looking at things not just in arrears, but also kind of throughout the year and how they need to approach. Maybe they get a stock grant. Is that what you said?
Yeah. So again, that's all very proactive tax planning. It's, what we do is we'll set up, stock alerts, right? So we typically end up working with a lot of these individuals pre-IPO, during the IPO, and post-IPO, right? So they're getting their options and things like that, and then, once it typically goes public and everything else, then we're kind of tracking that. If the stock drops a couple of points and they have incentive, ISOs, right, instead of stock options, like, hey, it might be a good time to exercise now. You're mitigating your bargain element, right? So your exposure to the tax is a little bit lower, right? So it's kind of, like an insurance policy, right? We're kind of that tax insurance policy in that sense, to have those meetings and just be proactive, right? It's typically, you have a lot of those conversations that most people are used to is like, how do I owe all this money? Well, it's you could have done X, Y, and Z. That's all reactive conversations. It doesn't make anyone feel any better, right? It's like, missed opportunities, types of things. So we try to, we'd like clients to be proactive in that sense too, and want the proactive advice.
So say somebody sells their company for, I don't know, $100 million, right? And so they have all this cash, and you kept mentioning when they want to move somewhere. It seems like that moving to a different state can cause a lot of maybe confusion on their part because they're like, I'm going to move to Florida. It's going to be a lot better, lower tax, right? How do you guys advise them on that, or what's like the protocol when talking about how to move after you've sold your company if you want to?
Sometimes it does involve lawyers, right? So, and some things are above our pay grade, right? When attorneys, typically those things can be somewhat factored in on, during the purchase, right? You want to maybe do something on an installment sale, so you're kind of breaking up the gains that you're realizing, so to speak. So, I mean, it really comes down to those conversations like, all right, well, what's the objective, right? We always try to be like, what's the goal? And how do we get there the most tax efficient way possible? The whole thing that you see online, like, people don't pay taxes, or I don't want to pay taxes every year. It's like, it's not really feasible, realistically, for being honest. And most people don't want to have that conversation or hear that answer. It's like, okay, well, how do we get there? And how do we do it in the way where you're keeping as much money as possible, but paying what you need to pay, and getting to the goal. So it always depends on what the client's objectives are.
So there's this guy, I think his name is Peter Schiff, and he's like a big proponent of, I think he lives in Puerto Rico, right? Maybe because there's no income tax in Puerto Rico. Have you heard of this guy?
No. And there is income tax in Puerto Rico.
There is income tax, so there's no way to avoid this, right? Unless you, as an individual, perhaps companies can do that. But it's, it's avoiding tax. Or how do you minimize your tax burden if you're moving to a different country?
International taxes, I don't deal with too much, to be honest with you, so I can't really answer that too much. I mean, we have some clients that are international. They work internationally, but as far as the, you're talking about FACTA and other things when corporations are moving abroad, again, that's not something we typically deal with.
Okay.
But again, in terms of tax mitigation strategies, right? Again, when it comes to certain, a lot of these individuals that are in a startup space, their portfolios are highly concentrated, right? So, all right, how do we diversify you? How do we work with your financial advisor to help you get diversified, mitigate as much taxes as possible, right? So there's mechanisms out there, like incomplete non-grantor trusts that can be opened in non-income tax states like Delaware, Nevada, things like that. They're called DINGs or NINGs, right? Delaware Incomplete Non-Grantor Trust or Nevada Incomplete Non-Grantor Trust that would help shield you, right, and from a large state tax burden. You pay the federal tax, but you at least could shield yourself from a state tax liability. Maybe not all at once, but it makes sense if someone has $6 million worth of stock and they move it to an incomplete non-grantor trust. Say they live in Jersey, if they wanted to exercise everything at once, they're going to pay $600,000 just on exercising all of that alone, right? Mm-hmm. So if we can mitigate $600,000 worth of tax, then we've helped save our client a lot of money just in that one regard.
Yeah, I keep hearing this phrase AMT, and I'm wondering, can you describe it, and just how does that come into play when you're talking about the restricted stock options?
So incentive stock options are something that have to be factored in for AMT purposes, right? So AMT is kind of like a second tax system, right? So the government came up with this, I think, in like the 60s or 70s. They just basically wanted, the wealthy to pay their fair share. So the calculation for AMT doesn't really provide for, the standard deduction and, all these other benefits that you would get under, the regular rules, right? With your itemized deductions, your mortgage interest, property taxes, and all the other things. So the bargain element is something that does get included for AMT purposes. So depending on what that spread is between your exercise and the fair market value, you could trigger AMT tax. So depending on, normally, right, these private shares, you're buying them for typically under $10, $15, $20 at most. And if this, the company goes public and it's a hot stock, say, maybe it's in tech, then the shares are trading on the open market, they're worth $150, $200, $300. Now you have a $10 cost basis, and say it's $300, and they have a $290 spread. So how many shares are you going to exercise? What's your capital? How much liquidity do you have? Because you have to pay those taxes. You do get a benefit for it down the line, so it's, again, a planning mechanism. So how do we utilize those prepaid, because then the realistic prepaid taxes. So how do we utilize and take advantage of those things? But the AMT hit is something that a lot of people don't expect. Ironically, the ISOs were a tool used back in the early .com era with Silicon Valley. They were giving a lot of their executives ISOs, and they were exercising them. And then when they got the tax bill, they didn't have the cash. Right, so they basically had to try to sell more stock or more assets they could liquidate to cover their liability, which then could potentially create more tax liability. So it was a mess back then. So that's why we try to plan accordingly when it comes to these things. So that's why it's like we'll set up Google alerts and stuff for stock, like, hey, your stock's down a couple of points, your bargain element is going to be at least mitigated by X amount. That would save you theoretically Y amount in taxes. Let's have a conversation, right? Do you have the liquidity right now to make an estimated tax payment, things like that? Try to mitigate that.
I think this is probably more a question for you, Dad. The corporate stock options, regarding like how if somebody suddenly comes into a situation like I imagine like somebody working at NVIDIA, and all of a sudden all of their stock options are just through the roof because NVIDIA's just exploded. And maybe they want to sell something. Like, how do they make sure that they can reduce any tax burden?
So, there's multiple ways to do that, and as AJ said, it kind of comes down to what you're trying to accomplish. They don't necessarily have to sell it. They can certainly transfer it into another entity that they own or the trustee of. Maybe they want to give some money to charity. So they can put it into one or several different charitable type of accounts, sell the stock, and then over the next 5 years, give it to charity. Maybe they wanted to give it to their kids or grandkids. There's another type of trust for that. One of the things I run into, Ryan, is corporate executives who it would be very bad for them culturally within their company to start selling their shares. I ran into ironically, AJ was talking about this about Citi. Well, I was working for Citi in 2008, and I had colleagues who could never sell their shares, and to AJ's point, they end up borrowing against them and then getting a margin call and just getting destroyed in trying to create enough liquidity to cover everything. So in those cases, maybe you change the title to something else, and then you solve it that way. The other thing that's not often talked about these days, at least in circles that I've been around, is there's also a mechanism where several of the larger banks will sponsor an entity called an exchange fund. And the drawbacks of the exchange fund is it's a long-term deal. It's usually 7 years or more. But the benefit is if you deposit your personal stock into it, you combine that with 20, 30, 80, 100 other people, and what pops out the other end is a diversified portfolio. So that's another way that you can deal with big stock concentrations. The final way I'll mention, and there are plenty of public figures who have done this, is every bank on Wall Street will just be delighted if you go to them and ask them to set up a hedging structure where they invent a tool, an investment structure that counteracts that stock going down. It's never perfect, but those kinds of hedging structures are another way to deal with big stock concentrations.
I have a question about exercising these stock options, right? Is there, like, timing-wise, is there ever a bad time to be exercising the stock? Maybe you're like, oh, we're at record highs. Now this is a great idea, but I have no idea what I don't know. So is there, like, a bad time to be exercising stock?
It's so individual. When we've talked about your situation, I've said, let's hold on to these things. They're not going to hurt you over time. But I think AJ will mention the fact that you got to come up with some cash if you're going to exercise an option. It's not something you can do without having some cash behind you. There is a tax component that I would defer to him with in terms of that spread between what your basis is and what the market value is. AJ, you may want to go into that a little bit more just to make sure that Ryan understands the answer on that.
Yeah, so I mean the bargain element, right? When you have these options, ISOs, NSOs, all right, that your spread, right? That will, depending on if the stock is through the roof, is that a bad time to exercise? Again, it depends, right? Do you have the liquidity? Let me cash out and get some money here. It's like, okay, well, you got to come up with cash to pay the estimates, the taxes that are due. Right, so again, it depends, right? So that's why we try to we'll work with our clients and see what the goal is, and sometimes hey, look, I got to sell. And it's like, okay, you take the hit when you do, right? We try to avoid that as much as possible, right? And it's also, again, what else factors into the play? Like, are there losses, right? Has their advisor helped them harvest losses that can help potentially offset some of the gains, right? But when it comes to just exercising the ISOs, your capital losses aren't going to help you because that's a straight tax calculation. It's a straight income tax calculation. So your losses will come into play when you go to sell something and everything else. Those would all net together. But when it comes to the AMT piece, you haven't sold it. You've exercised them. You hold them. You own them at that point. You've paid the tax on the spread. Now it's like, okay, now let's track it. Again, do other vehicles available to us now to try to avoid some taxes on the sale, right? Like I said, an incomplete non-grantor trust, something like that, to help with those things, right? At least if we can mitigate some state taxes, that would help, right? Those incomplete non-grantor trusts work in a lot of states, but there's some states that have caught on to those things, like New York and California. So they don't care. If you oh great, you have a trust in Delaware and you moved your shares there, doesn't matter. When you sell it, you owe the full tax to the state, right? New Jersey hasn't caught on to that yet. So again, there's certain states that you can get away with it, and other states where it's like it's not even a conversation because it's not worth it. You're not saving anything. You're just creating more work for nothing.
Is New Jersey? Are they trying to start doing that or no? Do I have some time?
I haven't heard anything as of
Perfect.
yet. I mean, there's probably bigger fish for them to fry.
It sounds like if we have 100K in stock options and we want to put in a pool, right? It's probably going to cost, and say the pool costs 50K. It'll actually cost me more than 50K because exercising the stock options will trigger some sort of tax. And it might be 5K more, something like that, whatever the amount is.
Well, if you exercise them, you hold them, right? But are you going to exercise and then sell them?
Yeah.
Right. So then you've created theoretically a double tax liability. Right. If you have no losses to offset and it's a full gain, then you're going to pay the tax on tax on the spread.
So it's not as simple as just exercising the taxes, because you then would have to exercising the stock, because you would then have to sell it. And then you're a double tax thing right there. Okay. This is very interesting. I'm happy we're having this conversation because maybe I'll just get a subscription at the Y instead of put a pool, or improve my pool as it is. It needs a lot of improving. Well, we've covered a lot of ground. Dad, do you have any more questions for AJ?
So there's a fairly, what would I say it? A fairly seldom discussed version of gifting where the younger generation, who's an adult, gifts to their soon-to-pass, or older at least, parents some of their low basis stock, called forward gifting. Sadly, the parent passes away, and the cost basis is marked up to the day of death. Have you ever run into that situation? Has that ever come up in conversations, or am I catching you blind on with that one?
Haven't heard of that one, to be honest with you. Gifting, you would gift stock to your parents, low basis stock, to get the step up in basis.
So remember, we are at least for the next 18 months, something like that, living with these enormous, estate, enormous amount of money you can have in your estate before you have to pay estate taxes. So this is not an income tax issue. This is an estate tax issue.
Right.
So we have this enormous amount. So son or daughter has a low basis asset. Maybe it's real estate. Maybe it's low basis stock. Mom or dad, who's still alive, their health is waning a little bit. So you give that stock using that lifetime gifting ability. You gift that stock to mom or dad, and you make sure that in their estate documents you get it back upon their passing. They keep it until they pass away, and then at that point in time, like all non-qualified assets, the basis gets stepped up to the date of death. And then in the estate planning documents, it's given back to you. I have brought that up in multiple occasions to clients, and in every situation they'd say, you know what, I have a sister or brother, I don't really want to even bring that up with my mom or my dad. But it's a viable approach. I just wonder if you bumped into it at all in your conversations.
Have not come across that at all. Typically, again, the conversation we're having, it's like, don't really gift anything, right? Because again, when you gift something, your basis transfers over to them. You kind of just want to die with the asset, so then yes, you get the step up in basis. Right? Like, don't gift your house and all the other things. It's just either have it go to a trust where then it gets step up in basis,
right?
Things like that. So you want the step up for sure.
Gotcha. I think that was the one question I wanted to ask him, Ryan.
I just want to clarify, what does it mean to step up in basis? What's the basis here in this context?
I'm going to defer that to the CPA.
Yeah, so again, for example, let's say someone's parents bought a house, and they own stocks, right? They own stocks. They owned like AT&T back from like the 50s or whatever it is. They paid, I don't know, $1 for it, whatever it is. So the step up is the assets get stepped up to the value on the date of death, right? So whatever AT&T is trading for on the date of death, that then becomes your basis, right? So it wasn't the dollar they paid for it. If it's trading at $150, $200, whatever it is, that becomes your basis. You could then go to sell it right away, and then you really mitigate any exposure to tax, right? It typically happens with the sale of primary residences, like, hey, my parents passed away, the house gets stepped up in value, you go to flip it, sell it right away. There really is no exposure there in terms of those things. If you hold the assets, then yes, if there was an appreciation after the step up, then you would owe any potential taxes on those things.
Oh, I see.
Yeah,
so
but
it's
you
all
want
about the price of the stock.
You want the step up because you want the fair market value of the asset.
Oh, I see. Okay. Cool. Well, thank you very much for all of your insights here. How can people find you if they're looking for a way to make sure they're approaching taxes in a smart way?
Best way, email. Our website's currently under construction, all right, but email is Albert, Albert, at campofg.com. You can find me on LinkedIn. I'm also on Twitter as well, pretty active on Twitter. My Twitter handle is AJ the CPA 1226. There's a lot of information on there, especially during COVID, right? I was sharing a lot of information with the CARES Act and all those other things that I got interviewed by Forbes, New York Times, Bloomberg, CNBC. So I typically contribute pretty frequently to CNBC. Ironically, I was featured in an article about NVIDIA stock options.
Oh, really?
And how that would potentially impact. Yeah, that was on CNBC Pro. One of their writers there that I'd spoken to a lot during COVID for her articles. Yeah, reached out to me about that. She's like, I know you deal with this a lot. Let me get your insights on, say, so who's someone's at NVIDIA. How would they approach their now highly appreciated stock?
Yeah. Oh my God.
Things
Well,
like
we're
that.
in good company. We appreciate you coming on.